You want to teach you have teach you have teach us anything this time, Brian.
Good evening, SFL2 Boku. Good evening, everyone. Right. Strategic financial management is very simple, and like I used to say, it's just for you to understand the principle. And the principle is the rule of the game. Like once you understand the principle, I believe you can solve any question in SFM, right? So tonight, we'll still be looking at some principle that guys the merger and acquisition under the share for share exchange, meaning that if I want to acquire Toib Nigeria Limited, am I audible enough, please? Am I audible?
Yes, we
Yes,
even
sir.
enjoy this voice tonight.
Yes, you are.
Okay. That's fine. So if Toib want to acquire Abbas Limited, so Toib may decide that okay, it will be on share for share, meaning that on share for share, meaning that for every 3 share in Abbas, for every 3 shares in Abbas, I will give 2 shares. Class. For every 3 shares in Abbas company, for every 3, I will give 2. So that is share for share. Examiner may ask you to calculate the percentage gain, right? After the acquisition, right? We need to do that. We need to calculate that. I think this question is one of the I can pass question. I don't actually know the diet, but I know it's one of the I can pass question. Then, which other part of merger and acquisition I need to take? I think that the merger is not like the merger part of it. They say something is the merger, so you remove that part, right? All in all is to determine the value. Determine the value before the merger. Determine the value after the merger. Right. Now this question is question 1, not question 3. I think question 1 is 30 marks. Right. So please, can someone read?
Yes, can I go ahead?
Yes, please.
Okay,
Salahuddin. Sorry, ma. Salahuddin. Oh, Salahuddin is not in this class. Is it Salahuddin? Yes, Salahuddin Gabriel, right? I think Salahuddin. I told him to reach out to me for his data.
Abi, let me collect it on his behalf.
They play. So please, Salahuddin, when you come online, or okay, I'll post that. Okay, please go ahead.
Okay. A. Prepare a schedule of forecast free cash flow to the firm for each of the years from 31st December to 2024 to 2027. B. Estimate the fair value of LT's equity on per share basis.
Thank you. Now, the examiner says determine the forecast free cash flow to the firm. That is free cash flows to the firm from 2024 to 2027. And examiner still asks you to calculate or to estimate the fair value of LT equity on per share value. Fair value is the market value. Fair value is the market value of LT equity per share. All right. meaning that you need to divide the value by the numbers of shares, right? It's or more. Like say I won't sleep. Oh.
Hey, I
You
think I
don't- you don't-
You,
Now you have
you don't believe. You don't
I've been
believe.
overfeeding. This one overfeeding though.
Now, true,
I mean, you know, it's
people
funny.
want to get that. It's
over
like-
What is over? Please, a minute. Let me just take something. I beg. A minute.
Please come back. Go. Who is against Mr. Ibrahim tonight? Yes.
Somebody
This
said
one
it's
that-
against him today. The person has started.
I don't start. Hey, na me.
Let Mr. Ivy not take a minute from there because those of who.
Mr. Ibrahim, if you don't sleep, make we don't know.
Okay, I'm back.
Thank God.
So the C part, quickly C. Madam, are you still there? Okay. LP intends to make an offer to LT based upon a share for share swap. LP intends to make an offer. So, meaning that LP should be the acquiring company, the main company. So LT should be the acquired, which is the target company. So we want to do share for share swap. LP will exchange one of its shares for every two LT shares, just like the way I just explained now, that for every 2 shares in Abbas Limited. So if we give them 1 or we give them 2 for every 2 shares in Abbas, that is what it means, right? Now, assuming that LP can maintain its EPS of 12.2, so the EPS for LP is 12.2. Calculate the percentage gain in equity value. The percentage gain in equity value that will be earned by both groups of shareholders. D. This is 7 marks. D. What factor should the LT shareholder consider before deciding whether to accept or reject the offer made by LP? What are the things they need to consider? Right. So the question, don't forget that the examiner says we should determine the free cash flow to the firm. And something should just start coming to your mind, which is the format of free cash flow to the firm. Right. Now, LP is a very successful entity. The company has consistently followed a business strategy of aggressive acquisitions, looking to buy companies that it believes were poorly managed and hence undervalued. LP can be described as a modern day conglomerate, and its business interests stretch far and wide. Its board of directors has chosen the takeover targets with care. LP has maintained its price earning ratio on the stock market at 12.2. Can you see the price earning ratio of LP? LP figures show a profit after tax of 4,430,000, and it has shares, meaning that the profit after tax of LP is 4,430,000, and its shares is what? 375 million. LT, which is different from LP. Don't forget, LP is the acquiring company, which is the main company. LT is a well-established owner-managed business. It has had its ups and downs in financial terms, corresponding directly with the state of the global economy. Since 2008, its profits have fallen each year, with the 2023 value standing at, they give us the 2023, the financial figures of LT. Can you see it? The income statements only. But we're given the summary of the numbers of shares to be 150 million, and the earnings per share of the company is 8.57. Can someone divide 1,286 by 150 million? 150. What do you have? Do you have 8.57?
Yes, 8.57.
Yes.
Okay, correct. Now, with economists predicting an upturn in the global economies, LT management team feel that revenue will increase by 60% per annum up to and including 2027. Don't forget, the requirement says prepare the free cash flow from 31st 2024 to 2027. Definitely the financials given to you is for 2023, right? So there will be a good rate in the revenue up to and including 2027. The company operating profit margin is not expected to change for the foreseeable future. So we will have operating profit margin. Operating profit margin is not expected to change. The question is, what is the company operating profit margin? Because the operating profit margin needs to also increase. If your revenue increases, your operating profits will also increase. Should also increase. Operating profit are shown after deduction on non-cash expenses, including tax allowable depreciation of 650 million, meaning that the operating profits has include the 650 million of depreciation. And this is expected to increase in line with sales revenue. Something should come to your mind here that your add-back depreciation will increase in line with 6% of the revenue, 6% per year, in line with the sales revenue, right? However, The company has recently, please, I hope you take note of this part. The revenue will increase, the operating profits, as well as the non-cash expenses. However, the company has recently spent 1,050 million, 150 on purchase of non-current assets. They use that for the non-current assets. LT management believes, now this is non-current asset, right? They've talked about the revenue, operating profit, the non-cash expenses, now the non-current assets. LT management believes this value will have to increase by 10% per annum until 2027 to enable the company to remain competitive, class, meaning that this will increase, which will reduce the company cash flow. LT is currently financed by debt and equity. LT is the target company, right? It has maintained a constant debt to assets ratio of 40%. And if you say debt to asset, it means debt to equity. Your asset, your net asset is equity, right? Debt to asset is debt to equity, right? And we have 40%, meaning that the value of debt will be 40 and the value of equity will be what? 100. And there is no intention to change this financing mix in the nearest future. The company is being financed by debt and equity. LT has no observed equity beta. They don't have equity beta. However, a similar company, ZK, operating in the same industry as LT, has an equity beta of 1.5. Class, what does this mean? If we have a similar company and they have equity beta of 1.5, and we have this, what does that mean? Where are we heading to? Thank you. There is a proxy company where we need to determine the weighted, because it is free cash flow to the firm. You use it is free cash flow to the firm, right? It is free cash flow to the firm. Class, remember that this company did not have equity beta. If you want to use the equity beta of the similar company, you have to determine the risk by determining the appropriate cost of the capital. Because they don't have it, you have to look for a similar company, right? The yield spread of LT non-current debt, class, under the bond valuation, when you want to determine your yield to maturity under the credit rating, it is your government spot yield plus the corporate rate or the credit spread. Is that not so? Now, they give you that the examiner says that LT non-current debt, thank you, Toyib, the only debt in issue over risk-free rate, currently 5.1%, is 90% basis point. The only debt in issue over risk-free rate. Now, the question is, what does the examiner want in this part? Is that your yield is 5.1%. We have to compensate you by adjusting for it. That is why you have basis points of 90%. So it means that 90 basis points So it means that when you are adjusting for it, we have to be 5.1%, 5.1 plus 0.9. Right? We are compensating you, the basis point, the credit spread, we are compensating you for the risk taking, for that risk that you take. It's all of you to spend your money. You invested it in a risk-free asset. And we were told that the only debt in issue over risk-free rate. Now, they are telling you that the examiner is saying, we have debt to over the risk-free rate. What it means is that your debt is also your risk-free. And that is the reason why the examiner says that we will give you 5.1%, but we will compensate you for not what? For not consuming, for not for investing your money, right? We'll talk more about it when we get to the point. Equity market premium is this, and we have all the information. Some of LT major shareholders are not so confident about the future and would like to sell the business as a going concern. The minimum price that they would consider will be the fair value of the shares. The fair value, the market value of the shares plus the 10% of the premium. That is what they will consider, right? As what they will sell the business. LTCFO believes the best way to find the fair value of the shares is to discount the free cash flow, is to discount the forecast free cash flow to the firm. Class, can you see it? The CFO believes that for us to get the fair value of the shares, we have to discount it with the forecast free cash flow to the firm. When you get your value of the shares, when you get your value, you divide it by the numbers of shares. It will give you the fair value of the fair value. And assuming that beyond 2027, this will go at a rate of 3% per annum indefinitely. Now, class, what is this beyond, class? Beyond. What is the beyond?
Infinity.
Infinity, that is the terminal value, right? Infinity, class. So this question is as simple as ABC. So suggested solution. So I think we don't finish the question now. So see you in our next class, right?
Away.
Yeah.
Don't leave us.
So suggested solution. We'll start with A. Please mute your mic. Free cash flow to the firm. Well, first of all, determination of free cash flow to the firm, right? You don't forget that you want to value LT. And the CFO believes that the free cash flow to the equity, free cash flow to the firm, the discounted free cash flow to the firm, discounted forecast free cash flow to the firm should be used as the value, at the fair value of the shares. So we may have to do some little conversion here, but it's fine. What is all these things now? Okay. LT. Okay. Okay. LT determination.
Okay, this question, sir.
I don't know, honestly. If you have your material, you can just get it. I don't know. I don't know. I just know that I saw the question and I feel it's a technical question too. And this is the kind of question I can like to set, right? Very technical for you to, you see how it is, right? Determination of free cash flow to the firm. That is the first requirement. So if we have this for how many years? For 4 years, right? For how many years? 2024 to 2027. So we can have 2024, 2025, 2026, and 2027. So okay, please, this is very important. Presentation, right? Now, if you want to determine free cash flow to the firm, we have to start with, we're supposed to start with profit after tax. But because it is a forecast, we have to forecast our revenue based on the information given to us that the beliefs, the revenue will grow by 6%, including 2027. And the revenue is 7,500. Ideally, if it is just for only for 1 year, we would have just say profit after tax. We'll start from here. But because of it is forecast. Add back this and subtract our CapEx, right? So we'll start with the revenue. We're told that revenue will increase by, so what is the revenue or the sales? What is the sales figure given to us?
7,005.
Excuse me. So 7,500, and it will grow by 6%. So if it will go by 6%, what do we have here?
7950.
7950. You go this, what do you have?
8427.
8427. What do you have here?
8933.
8933. What do we have here?
9469.
9469. Okay. So okay, after the revenue, right, we have the operating profits. But we were told that the operating profit margin is not expected to change for the foreseeable future, meaning that we need to get the operating profit margin percentage And that percentage, that is what we use as our operating profit, and it is not expected to change. Class, what is the formula for calculating operating profit margin?
Operating profit over revenue.
Thank you. Operating profit margin is operating profit divided by the revenue. It is not expected to change, meaning that the margin, the operating profit margin is not expected to change. Class. So therefore, we can have workings. You can say this is work 1, operating profit margin. Right? Operating profit, what is the operating profit figure?
2,400.
2,400 divided by the revenue.
7,500.
7,500. What is the margin?
32%.
32% is not expected to change in a foreseeable future, meaning that our operating profit is 32%. Class, 32% of what will be our operating profit?
Of sales, revenue of sales.
Thank you. The operating profit margin is not expected to change. How do we get operating profits? The operating profit margin is your operating profit divided by sales. We give you the profit margin. Then profit margin of what? Margin is of sales. And this 30% is not expected to change. So therefore, 32% of 79950, what do you have?
2544.
2544. 32% of this, what do you have?
2697.
2697. What do we have here?
2859.
2859. What do we have here?
3030.
3030. Class. That is what the examiner asks us to do. That the operating profit is the operating profit margin, and it is not expected to change. You've gotten your operating profit margin. Margin is on what? Is on sales. Meaning that to get your operating profit, it will be that percentage of the revenue will give you the operating profit. And this operating profit already include non-cash expenses of 650. We'll get there. But what we want to calculate now is to determine our profit after tax. And after that, we'll add back our non-cash item. Right? So, did they mention anything about interest? No interest. You can see that no information about interest. That whether the interest here will increase for in line with revenue. It wasn't mentioned. So we have to ignore it, meaning that they've paid the interest that year and it will not increase. If your interest will increase, it would have been stated that the interest will increase by 6% in line with revenue, or maybe by 2% or 3%, right? Because there's no how you want to bring in your interest, or will you just say interest here the same amount? No, because you are actually forecasting for the future, right? So therefore, we have tax. How many percent of the tax given to us?
25%.
25%. We have 25%. So what do we have? 25% of this, what do we have?
636.
Okay. Come. Six 36. What do we have here?
674.
674.
715.
715. What do we have here?
758.
758. After this, we have parts. There no right part for example. Parts. Okay. Oh, big. It's profit after tax. So what do we have here? Quickly, what do we have? What do we have? What do we have? What do we have? Quickly.
1908.
1908. Mary, are you in this class? No.
I am. I'm struggling with sleep.
2023.
The last one, 2027, 2272.
2272.
2025. 2023.
2023.
2026, 2144.
2144. So after this, we can now add back. We start our cash flow. Non-cash expenses, which include depreciation. We were told that the non-cash expenses, which include depreciation, is 65,650 million. Can you see it? Can you see it? And this is expected to increase in line with the sales revenue. 650 times 1.06. What do we have?
689.
689. What do we have here?
730.
730. What do we have here?
774.
774. What do we have here?
821.
821. We had it back because it has been included in the operating profit margin. We have non-current assets. Current assets. We're told that the non-current assets, what will happen to it? We increase by 10%, right? 10%. 1.1, right? So what is the value of the non-current assets? I think it's 1,050.
1,050,000.
Okay. So 10% is 1.1, right? Is it 1.1?
Yes, sir.
Okay. Since I'm the only one in this class.
Yes, sir.
What do we have here? Non-current asset.
1155.
1155. What do we have here?
1271.
1271. What do we have here?
1398.
1398. What do we have here?
1537.
1,153,000.
Okay,
37.
37. So we don't have amortization, no impairment, no loss on disposal. Which other one again? No profit on disposal, no replacement costs.
Working,
There is no working capital,
working capital.
right? So what do I have?
Repayments of
Before
debts and issue of debt.
What did you say?
I said something like repayments of debt or issue of debt.
For where?
That one not to equity. That one's to equity.
For where? Where is the increment of debt to? They say it is being financed by equity and debt. This and this is talking about policy. This is talking about the risk-free and the debts. So, so if
I think no, it is included in the formula, but I'm saying it's not included in the question. So
okay, no. The debt, the increase in debt is equity now.
It's equity. It's not included in formula for firm.
Firm.
Free cash flow to firm.
but
Right.
well, the thing is that Mr. Ibrahim, I come across a formula whereby they can give us free cash flow to equity and say we should determine free cash flow to firm. Then we move on. That's what I'm trying to say.
They give you free cash flow to equity. Then I say you should do free cash flow to the firm. Is that not so? Right?
Yes.
So if don't worry, you understand something now. Don't worry. So what do we have? I get your point, but you understand something now. Why this thing is not working now? Oh, what do we have here?
1442.
Wow. 1442. What do we have here?
1482.
1482. What do we have here?
1530.
1530.
20.
1520. What do we have here?
1556.
1556. Class. This is what the A part of the question says we should do. Free FCFF. I better no write FCFF. Oh. It is free cash flow to the firm. That is what the A part of the question says we should do. Just say, the examiner says, calculate the free cash flow to the firm only. Then the next question that is 13 marks. Taib. The next question that is 13 marks. You should not forget.
Mr. Ivy, why are you calling my name?
No worry. You should not forget that the CFO believes the best way to find the fair value of the shares is to discount the forecast free cash flow to the firm. Class, when you want to discount free cash flow to the firm, what are you going to use to discount it?
WACC.
Thank you. Now, that is the beliefs of the CFO. That makes sense. But the question now is, how do we determine the WACC? ideally we were supposed to just look for the work of LT. That is what we're supposed to use, the work of LT. I don't mean all information is given to us. But guess what? We have to determine the risk or the appropriate weighted average cost of capital. Because LT has no observed equity beta. Equity beta. And we need them. We need equity beta of LT. When you want to determine your work, you will need cost of equity now. Is that not so? So because they don't have it, they have to use the data of the similar company. So when it involves a similar company, you have to use the appropriate work. Class, am I communicating, please? Am I communicating?
Yes.
Right? Can you see it? We're supposed to use, when you want to determine work, you need cost of equity. You need equity beta. But they don't have equity beta. So how will you determine your cost of equity? Now the examiner now says that, oh, we have a similar company. Yes, you may be doing a research, you may be a research analyst and you want to value the business. The business does not have equity beta. What you need to do is that look at a similar company, like a financial institution. Look for a similar company, right? Maybe you want to do valuation on maybe Jitco, for instance. Look for the similar company with the likes of Stanbic and Zenith. Use it, right? Use it to determine the appropriate weighted, because that will take you to appropriate cost of capital, because they don't have the equity beta. I don't mean now they have the equity beta. We don't need the appropriate cost of capital. We don't need it, right? So therefore, wow. O B we okay. B. We should not forget that the CFO believes that we have to discount the free cash flow to the firm. But the requirement of the question says estimate the fair value of LT equity on per share is equity, but the CEO believes that whatever thing you want to do, we need to get the value, the fair value. What will be the market value of the company? So when we get that, then we can go from there, right? Can go from there. So now the B part of the question, which is B. Oh, okay. B, right? We need to determine what is that, self? Fair value of equity per share. Of equity per share. But we can't get this fair value of equity per share if we don't discount it with the work first. Class, just observe, right? Just see how we want to derive all these things, right? So this is my free cash flow. You discount it, it's here. Now we need to determine the appropriate step 1. Identify the policy company. What is the policy company? ZK. Step 2. Determine the asset beta. Is equity beta given to us in this question?
Yes.
Is equity beta? Okay, yes. Asset beta, sorry. Is it equity beta? Okay, beta debt, sorry. Beta debt. Do we have any
No.
beta debt? Okay.
No.
No beta debt, right? So we have to pick the first formula, right? That formula don't go. Yeah, I need to go and pick it. I need to pick that formula, right? Because my keyboard is still not working. Where do we have this? For these village people, when his search button is not working. Okay. Let me check something.
And you can take the work, the one we used last week and last time work.
Weighted average. We want to use, okay, don't worry, self. Better assets. Better assets. What is our formula, self? Oh, God.
Beta of equity
BE.
divided by value of equity.
Okay, thank you. Value of
Equity divided by value of equity plus value of debt into 1 minus
Okay.
tax.
Thank you. Yeah, good. Divided by
Value of
value
plus value of debt.
plus value of debt. Okay, okay. That's fine.
Into 1 minus tax rate.
Okay, okay, okay. A minute. Let me use let me copy something there. Oh. So value of debt, we have 1 minus t, right? Close bracket. So we were supposed to have plus better debt, but because the better debt, no better debt.
There's no 1 minus t. There's no 1 minus t.
There's no 1 minus t.
This is Miller and Modigliani now. Abi theory proposition 2. There is tax in the
Oh,
question.
sorry. Sorry, I thought it's 1.
Hello, which one is Miller and Modigliani? No, I'm not using Miller and Modigliani here. I'm using the steps for risk. The steps for calculating risk adjusted cost of capital. Now, it's me I they use for you.
That
is the principle now. There is tax in the question.
Yes, you're right.
Okay. Okay. I hear all of now. So we have this, right? This is the formula for calculating the asset beta, right? Right. We have asset beta. We would have a better debt, right? Because would have better debt because better debt is not given to us in this question. So that's why we didn't add that part, right? So therefore, BE. What is our BE? Equity beta of the policy company. What is the equity beta? Equity beta of the policy company. Class.
1.5.
1.5. Now only you did this class. 1.5. Right. Then the tax rate. What is the tax rate? How many
25%.
25%. So the level of gearing.
1:3. Debt to equity.
Please, I can't hear him again. No. Please, am I the only one? I can't hear Mr. Ibrahim.
You're not the only one. I think he has network issues.
Okay, thank you. They shout him up because I don't know.
Where is Mr. Ibrahim?
Ogechi, please, what year is this solving?
He said he cannot even remember the year. But he has this part of his handouts. Their material is in the material.
Okay.
It's from the material that he sent. Yeah.
2018, question 3.
Okay, 2018.
That 2018 question. No, the 2018 question 3 does not have these other things he's saying again.
It was an adapted. It was an adapted.
It's not exactly what he's saying. Yes, it's adapted. It's not exactly. Okay, thank you.
You're welcome.
Let's go and sleep.
Okay, please confirm. Apologies, please. I think my network logged me out.
Yeah.
So we move from here. The debt to equity ratio, right? What is the debt to equity ratio of the deposit company?
1 is 3.
1 to 3. Value of debt is 1. Equity is 3. Right? So we have this is 1. This will be 3. So therefore, I can copy this. Equity beta 1.5. The value of equity
beta is
1.
1.
This is 1.
Equity is 3.
Mr. Ibrahim, equity is 3 and debt is 1.
Okay. So
debt is 1. Equity is 3.
So we can have this is 3. This is 3. 1 minus tax rates. 25. BA. Please, what is our BA here?
1.2.
1.2. 1.2. Okay. So if this is 1.2 for BA, so our CAPM, I'm still going to waste my time here. So cost of equity, right? So sorry. What is our step 3? Step 3. What is the next step?
Reject. This is the LT info.
So BA should be 2.
Oh.
BA should be 2.
How?
It's
5 divided
1.2.
by 2.5.
It's 1.2.
4.5 divided by 2.25.
No, 4.5 divided by 3.75.
Okay. Okay. No, that's a no copy formula. So we have to regear. So determine the equity better. Right. Okay. So our BA is 1.2.
Maybe we should check. It's 1.5. Ali.
BA is 1.2. This is 1.2.
BA 1.5.
It's
Right.
1.2.
Please check. 1.5 is BA.
So
It's
this
1.2.
It's 1.2.
So this will be 0.
It's 1.2.
The better depth is not given. This will be 0, right? So we should not equally forget that this part here is for the main company. We treated this under the risk-adjusted cost of capital, right? So this part here is for the main company. So therefore, I can come here. What is the level of gearing for the main company? Okay. Gearing for the main company. What is the level of gearing? Debt to what? Debt to total.
I think 40% is the debt, so equity will be 100.
Debt to total assets. Debt to total assets for the main company, LT, of 40. Or 40. So therefore, okay. So value of debts will be 40. Value of equity will be 100. So therefore, Madam Victoria, are you still in this class?
Yes.
Please confirm that asset beta. Is it 1.2 or 1.5?
It is 1.2, sir. It is 1.2.
It's
Okay.
1.2, sir.
Okay, thank you. So what we have here, the value of debts is 40. Tax rate is 0.25, right? So do we have tax rate for the main company? Sometimes they may give us separate tax rate for the main company. Do we have? Okay, assuming the same, we have tax rate of in all cases. So stated that is in all cases, right? Sometimes they may give you, you may have, I equally explained this when we're treating the risk adjusted cost of capital.
I'm still wondering how you people got 1.2. And we have 1.5 times 3 all over 4.4 times 0.75.
You cannot add the 4 together. It is 3 plus 1 bracket, 1 minus 0.25. You don't add it as 4.
Okay.
You use this 0.75 times 1, then you plus 3.
Okay.
It's God mass. Follow your God mass.
You don't follow. If you wait,
Okay, sorry, please. Equity beta, risk-free. What is the risk-free? Okay. So we need to go back.
5.1.
So let's start from here. What is the equity beta here? What is the equity beta?
I got 1.56. That's what I got to.
1.56.
Yes, sir.
So therefore, this will be 1.56. So what is the market return given to us in this question?
I think we are given risk premium straight.
Okay, risk premium. What is the risk premium? 6.611, right? 6.6 6.611. Okay. Now, how do we determine the risk-free class? You should not forget that in the question, it was the examiner says that where is it? That the yield spread of LT non-current asset debt, non-current debt, the only debt in issue, right? The only debt in issue. Now, what it means is that you have the issue a bond, right? That has a yield over the risk-free rate. Now, the risk-free over the risk-free rate currently 5.1%. Now, what it means is that you should not forget that when you have yield spread is like your government's spot yield. Government spot yield. And government spot yield is usually risk-free, right? And it is usually what? Usually risk-free. And we're told that the examiner says that the only debt issue, what it means is that the debt that you have as government bond, since it is a government bond, there is risk-free, which is currently 5.1 over risk-free, meaning that you have your risk-free is 5.1, but it is over because of the spread when we have 90 basis points. Don't forget, under the bond valuation, when you have government spot yield, and government spot yield is always risk-free because it is assumed that when you invest in a government bond, it will be risk-free. Is that not so? Then when you are given the credit spread, you have to adjust for it. You can see that we are given 5.1 and 90 basis points, and they are risk-free. It is a debt, but they are risk-free. Is that not so? So we need to adjust for it. So whereby we will now have the 5.1% plus the 0.9 will give us the rate for risk-free. which is the only debt in issue, meaning that your debt, your government debt, is risk-free. When you have the yield spread is usually on government bond class. So we can have this, and government bond is risk-free. So we can have, where is it? Oh, so we can have 5.1 plus, what is the basis point?
0.9.
Everything is
Plus 0.9. So cost of equity is equals to, when you add these two together, what do you have?
6.
You have 6 plus, when you multiply this, what do you have?
10.31.
10.31. So therefore, cost of equity, what do we have?
16.3.
16.3%, or this will be 0.163, right? 0.163, right? Okay.
Yes, sir.
Step 5, the WACC. What lead us to all these things is because LT did not have equity beta, and they have to use a similar company. Therefore, when you want to discount, you have to use weighted average cost of capital to discount. And don't forget to discount the free cash flow to the firm. And don't forget, the question says the value of shares. Is that not so? Okay. Now, so our weighted average cost of capital, where is it? WACC. Away. So I didn't write this formula. Okay.
Yeah, let's give you for it.
No. I've not my keyboard actually. So if not, I would have just write it out. WACC again. So okay. Our cost of equity is this. Okay, what will be our value? Let me bring it down here. Value of debts and value of equity. You should not forget WACC now, main company. WACC, oh, not POSIO. So what is the value of debt in our gearing? For the main company, I can just check this place. You already have it in your step. We already have it in step 3, right? So our value of debt is 10. 10. Is it 10 or 40? I'm going to soon. It's 40.
It's 40.
Right? Then equity is 100. Right? So therefore, the cost of equity is 0.163 times value of equity
100.
Value of equity, value of debt, right? Value of debt is still the same thing when you use ash total. So value of debt times the cost of debt. Don't forget that our cost of debt is risk-free, KD, which is the 5.1% that we adjust plus the basis points, which is 0.9, which is the credit spread. This will give us 6%, right? And we're not told that this 6, let me just use this 6. We're not told that this 6 is post-tax. Is that not so? We're not told that this 6 is post-tax. So definitely we have to do our tax relief on the cost of debt. So cost of debt equals to 6, open brackets, 1 minus tax rates. What is the tax rate? 0. What, class?
25.
25.
25. So what is the cost of debt? What do we have?
4.5.
4.5. Right. So this 4.5 is 0.045. Can you see it? We're told that the non-current asset has a debt in issue, where we have the only debt in issue, and it is yield. For you to have a yield spread, definitely that debt is a government bond, and a government bond is a risk-free class. Is what is risk-free, and that is why we adjust for it here. So,
Mr. Ibrahim, sorry, I'm still getting that is confusing, kind of.
I'm still, we are not done yet.
Confusing, sincere.
You have to go back to your bond.
Yeah,
What is bond?
I understand that principle, but I'm thinking 5.1 should be the risk-free.
No, it cannot be.
That the English over the risk-free rate. That's what I'm trying to.
It cannot be. Do you know why?
Why, sir?
The yield spread is government bond, and it is an issue class. They will compensate you. You already have credit spread. You can use this 5.1. This yield here is the government bond. The risk-free is this 5.1. Who compensates you with this spread? You have to add it together.
That means we are having corporate yield spread like that. If we add that 0.9 to it,
it is, yes.
We'll be having corporate yield curve like that. But me, I believe in the formula, they only said risk-free. So I think when we want to calculate the cost of debt, that is when we are now going to factor in the corporate yield curve. We are going to add it, then minus our tax. So it is kind of confusing, kind of.
It is not. You have to clear your mindset first. Do you get? You have to clear your mindset first. Who is that? Please, can you mute your mic?
Okay, good evening. Oh,
I'm
sir, I thought
I'm still talking.
Okay.
Can you allow me to explain first, please? The yield spread of LT non-current debt, the only debt in issue. When you have yield spread, it is a government bond, it is a government debt. If bond today is 5%, they've adjusted for credit spread, they've added compensation to it. That is why you have 5%. And they told you that it is over the risk-free, meaning that your government spot yield is risk-free now. Is it not risk-free? It's risk-free. Then it is over the risk-free. What is the risk-free? 5.1%. And they give you basis points. Are we going to throw away the basis points? Won't you compensate me for not using my money to buy something, to invest in a government bond? And the government bond is risk-free. So whichever one you want to use, it is risk-free. Risk-free is government bond, and you have to adjust for basis points. The credit spread that you have there, what is credit spread? When you have a basis point, it is a credit spread, it's a compensation. Right? It is a compensation. So you can ask your question now. Emmanuel.
Okay, good evening. What I wanted to ask was that when computing for work, I thought I had to use the elements of the main company. Like we using this 5.1 for the cost of debt.
Did you start this class with us?
I joined in late.
So you can go back to the YouTube and watch the video so that you understand why we use that this thing. Thank you.
Okay, thank you.
Yeah. Okay. Question? Any other question, please?
Mr. Ibrahim, actually, we can move on, but you see, some things like this, when we get to the exam, they are the normal thing that really cause issue. That's why I'm trying to hammer on it. So the thing is that I only believe, my own point of view is just that on government yield curve, we don't consider credit spread because we consider it as risk-free. My belief is that if we want to get our corporate yield curve, that's where we now consider that we are open to it that this company will not pay us. So let us add our credit spread to it. But now that we are adding credit spread to risk-free, so it's getting, is it that government too is, they are trying to, they won't be able to make the payment. That's why we are now adding the credit spread. So that's my questions. I want to get this question in case we meet something like this, another question.
Any other question?
Let's go.
Okay, let's go back to bond valuation. When we have the government spot yield and the credit spread, the question is, what is government yield? The return you will get in percentage, which is different from interest. We are talking about the return that you will get on your investment maybe for 4 years. And why do you have to have a credit spread? What is credit spread? Which is always being in basis points. A credit spread is a compensation given to an investor for not consuming that funds we give you. Right? It's my interesting to know that the governments, if they say bond is, I think today one of the bond, I think it's close today, right? It's one of the government bond, right? They tell you that it is 15%, or down is even interest. Let's talk about the yield. If the yield is 5%, they've considered a credit spread. A credit spread is not only on government bond, it is on both government bond and a private and a corporate bond. You have to compensate me for taking that risk. Although it is even a risk, you have to compensate me for not even consuming them, for me to even invest. You have to compensate me. Right? So class, whenever you have faced with question like this, when you have a yield spread, tell yourself that this is talking about government sports yield, government bond. And a government bond is risk-free. And you have a basis point. What you need to do is to adjust for it so that you will have your what? Your risk-free. That is why the question says it is over risk-free. Over the risk-free. Thank you.
Mr. Ibrahim, that's why I love you so much. I just get the explanation now. Thank you.
So we can move forward. We can move forward. WACC is equals to, what is the weighted average cost of capital now, please?
12.93.
12.93. Okay, 12.93 or 13%. We can choose anyone. Right? So therefore, what we would need to discount is you have 13%, right? So if we discount it, 13%. So what do we have here? What do we have here?
Oh yeah, this 0.88. 885. 0.885.
885. What do we have here?
0.783.
0.783. Kennedy, are you still in this class?
0.693.
Yes, I'm still here.
Okay, that's fine. 0.693.
693.
What do we have here?
0.613.
0.613. Class. What the examiner says we should do is to determine the fair value of equity per share. We can't get the value of equity per share without having our value first. And you should not forget that the CFO believes that the best way to find the fair value of shares is to discount the free cash flow to the firm. This is very important. And assuming that what the CFO means that you have to discount it with free cash flow to the firm, then and beyond, which is the 3%. Right? And what? And beyond, which is the what? The 3%. And beyond. Right? And the examiner says we should determine the value of equity. There is no how we can determine the value of equity. We have to follow the DCF based on the normal free cash flow. Discount it to with what? With WACC. Then after that, check if there is beyond, which is infinity. But in this question, there is beyond, right? Now, so what is our value? I don't think this. What is our value?
Yeah, 2024, 1,276.
Okay, I'm coming. 2024.
1,276.
1,276. What do we have here?
1,160.
1,160. What do we have here?
1,053. 1,053.
1053. What do we have here?
954.
954. This is the value. So, away. Big. Total market value from 224 to 227.
4,443.
I'm coming. Uh, 4,000.
4,3.
443.
4,443.
4,443.
Okay. Now, class. And there is beyond, which is 3%. 2027 to infinity. The last year present value, just pick the last year present value, 954. Grow it by 3%, that is 1.03 divided by the WACC, which is 13%, 0.13 minus the growth rate, 0.03. So what do we have here? What is the value?
Nine, 7, 3. 5, 0, 5. 9,000.
Total market value.
What do you have? 9826.
9826. So what is the total?
14,269.
14,269. Class, you've not solved the question. You've not studied the examiner the value of equity. You only calculate the total market value of the company. And please, can you mute your mic? And don't forget, let me take you back a little bit, right? Come, why is this thing not working now? Oh. Okay. Total, recall, total market value is total value of equity plus, oh my God, plus, oh, okay, plus what, class? Total market value away plus what, class? Total value of debt. Now don't forget WACC. What give you to the total market value? Is it not the total value of equity and the total value of debt, market value of debt? Class, we give you the total market value of the company. Class, you use WACC to discount. The total market value that you calculate here is the total market value of the company, which include equity and debt.
The corporate value.
But the examiner says the value of equity, not the total market value of the company. The total market value of the company include equity and debt. You use 13% to discount. This 13% include equity and debt. But examiner is telling you they purposely use that value of fair value of equity to be 13 marks. They want to see how you will arrive at value of equity. Class, when you are faced with this kind of scenario, and the first scenario says determine the value of equity, what is it called? Free cash flow to the firm, calculate it. The second one, for you to determine the fair value of equity, we have to discount, get your total value of the company, which include equity and debt. Now, how do we now get the value of equity per share? Now, let's calculate the value of debt first, right? Because this total market value of the company include both equity, market value of equity, and debt. So meaning that we have to subtract the market value of debt from the total market value of the company, so that we now have the total market value of equity. Then you cannot divide it by the numbers of shares. Why? Because you use WACC to discount. WACC include equity and debt. So therefore, value of debt. Value of debt. So what is the market value of debt of the main company?
40%.
How many percent?
40.
40 what? 40%. Are we there? The market value of the main company is 40%. Right? Let me take you back a little bit. Where is it? LT. Can you see? 40. So therefore, 40 divided by 100 times 14,269. We give you the market value of debt. So what do we have? What do we have?
5708.
5708.
So when you subtract it, you have total market value of equity. What do you have?
8561.
8561.
8561. Then you divide by the company numbers of shares. Oh, why this thing is doing like this now? Okay. Fair value of equity per share is equals to 8561 divided by, what is the numbers of shares of LT?
150 million.
150 million. Thank you. Of LT is 150 million. 150 million. Thank you so much, everyone. We'll continue from here in our next class.
57 million.
What do we have? What is it?
57 naira.
57 naira per share. That is the value of equity per share. The examiner wants to test your knowledge. Most time, question may come this way. Sometimes question may come this way that they want to test your knowledge if you understand total market value of a company. The total market value of a company include equity and debt. Why? Because you use WACC to discount. This total market value that you have here, it includes equity and debt. But the examiner says, what is the fair value of equity per share? Remove the percentage of debt so that you will have equity. I think the questions, the examiner said, oh, what is the value, fair value of the company now? You know that, oh, it is both equity and what? It is both equity and debt. You can see the examiner wants you to like, oh, how they want you to see, oh, how will you arrive at the fair value of equity per share? And don't forget, the CFO believes the best way to find it. I think I need to go. The fair value of the shares is to discount the free cash flow. Because the free cash flow
19 marks, please. 19 marks is a mark. 19 marks.
In
Right.
fact, Professor Ibrahim, we really appreciate. Thank you, sir.
Assuming that it will grow by 3%, right? Meaning that your free cash flow to the firm, discount it, grow it. Then, before you now say you want to determine the fair value of equity, because it includes both equity and debt. Ha! How I wish there is time.
Okay.
In fact, now the energy come. So thank you so much.
Mr. Ibrahim, we are continuing.
One more question.
So we are not done with the question, right? We still have the C part. So in our next class, hopefully we'll continue from there. So don't forget that our intensive class will come up on 28th of September. Is it September? October, sorry. October. So we already have the questions, right? And I will send the topic per day to the group so that you look at it, you see it, right? Then we also have CIBN. If you have someone who works in a bank that wants to write CIBN, right, preparing for ELM, right, the report is actually ready. So we can just do a little analysis on the exhibit, right? So in addition to that, if you have anyone that is actually writing, preparing for a CITN exam as well, maybe case study, right? Case study. So you can also refer that person to Next Gen Professional Associates, right? So thank you so much, everyone, for joining, and enjoy the rest of your evening. Please go back to the YouTube and watch the video again. It's on YouTube already. Thank you, and have a wonderful evening. Thank you.
Sir, good night, sir.
Thank you so much, sir. Good night, sir.
Thank you.